Okay, as we continue Chapter 9, we're now going to be looking at how do we estimate uncollectibles based on sales and accounts receivable. So, again, there's two methods that we can use under the allowance method. So these are both using the allowance method, not the direct write-off. Under the allowance, we have two methods. We can use the percent of sales method or the accounts receivable methods. Under accounts receivable, we have the percent of accounts receivable or the aging of accounts receivable, and we'll look at all of them. All right, so for the percent of sales method, we're basically taking the period sales times the percent that we estimate to be bad, and that's going to give us our estimated bad debt expense. So here's an example for that one. It says Musicland has created sales of $400,000 in 2017. It's estimated that 0.6% of those credit sales will eventually prove to be uncollectible. Let's look at how do we record that bad debt expense. All right, so we take the 400,000 times 0.6%, we get 2,400. So to record the estimate, we're going to debit bad debt expense and credit that allowance for doubtful accounts. Again, this is just for the allowance part of it. That's under percent of sales. All right, the other thing we can look at is percent of receivable. So in this case, we're going to take the year-end accounts receivable times the percent we expect to be uncollectible. So here we're going to be looking to see, okay, well, what was the estimated bad debt expense minus what we already had in that allowance account. And the difference between what we already have in the account and what we estimate it to be, that's how much we're actually going to debit that bad debt expense for. All right, so here's an example of that one. It says Musicland has $50,000 in accounts receivable and a $200 credit balance in allowance for doubtful accounts. They estimate that 5% of receivables are uncollectible. So we're going to take 50,000 times 5%. That's going to give us 2,500 as what we want our allowance for doubtful accounts to be. Since we already have a credit balance of 200 and we want it to be 2,500, we only need to adjust it by 2,300. So we're going to debit the bad debt expense for 2,300 and credit allowance for doubtful accounts for that 2,300. All right, the other one is aging of receivables. So this is where we break down that accounts receivable into see how far past due is each of the customers. So we're going to classify each receivable by how far past due it is. The farther out it gets, the more likely it is that we're going to have uncollectibles. So here's an example of an aging of accounts receivable. So we can see that we have the different customers listed on the left. We have the total amount owed, and then we have it categorized into either not due yet, 1 to 30 days past due, 31 to 60 past due, 61 to 90, and then over 90. So we've classified them. Out of the ones that are not due yet, we expect that only 2% are going to be uncollectible. What we'll notice is that as it ages out further, we're going to see that those percentages increase because the farther past due they get, the less likely it is that we're going to collect it. So we have 1 to 30 days past due is 5%, 31 to 60 days past due is 10%, 61 to 90 days past due is 25%, and then once we get to over 90 days, we estimate 40% is uncollectible. So we take each of those balances in those categories times the percentage. That gives us the estimated uncollectible for that category. We add them all up, and that's what we expect our uncollectibles to be. So we're going to look at what was the balance. The balance was 200. We determine what it should be. It should be 2270, and we're going to do our adjustment for that. The difference is 2,070, so that's what we're going to debit bad debt expense for and credit allowance for doubtful accounts. What we need to remember is that just like we just did for here, this is it had a $200 credit, so we're going to subtract to get the difference. But if there's a debit balance, we have to add because we have to bring that 500 to 0 and then add what we need to get. So if it has a $500 debit balance and we need it to be 2270 credit, we have to adjust it by 2770 and do the same entry. All right, so we're looking at the different methods. Percent of sales is the income statement focus, and the emphasis there is on matching. And we're taking sales times the rate to get the bad debt expense. On the other side, the balance sheet focus, the emphasis is on the realizable value of accounts receivable. So we can either use the percent of receivables or the aging of receivables, and we've just looked at how to do that. All right. Looking at the next section, we're looking at notes receivable. We're going to be computing the maturity date and recording the note. So remember, a note receivable is just a promissory note that they're going to pay a certain amount with interest, and it's going to be due on a specific date in the future. Now to calculate the maturity date. Remember, if it's a 60-day note, we can't just say that it's, July 1st to September 1st, because July and August both have 31 days. So what we have to look at here, this one it's saying that July 10th we received a $1,000 90-day 12% promissory note. So you have to look at how many days are in July then. All right, well there's 31. We didn't sign the note until the 10th, so we have to take those 10 days out. So it's 21 days in July that we're going to have to count in the note. That doesn't get us to 90. So we have to go to the next month, August. How many days are in August? Well, we have 31. So we're going to add all of 31 to that 21. That's going to give us 52. We're still not to 90. So we're going to go to September. September we have 30 days. That's going to give us to 82. So we're still not at 90. We have to go into October. So we know that going into October, we're going to get to 90. So how many days do we need to add? All right, 8 days in October to get us the total of 90 days. So our maturity date is going to be October 8th if it was a July 10th 90-day note. So that's our maturity date. The next thing we have to learn how to compute is our interest. So we're going to be looking at our interest computation. So it's principal times rate times time gives you your interest. So they give the examples here. 1,000 times 12% times 90 over 360 days. So it tells you here, if the note is expressed in days, we are going to base it on a 360 day using the banker's rule. So not 365, we're using 360. This is for an annual interest rate. If it's less than 1 year, we have to break it down by month. All right. Now when we're looking at how do we record accounts receivable. Before it's treated the same way as accounts receivable. So we're going to be debiting that notes receivable, crediting our sales. The note was for $1,000, so we're going to debit notes receivable, credit sales. When it's time to collect it, then we will be debiting cash and crediting that notes receivable. Now here's something I have to think about too, is sometimes we might have someone that doesn't pay the note. If they don't pay the note, we're going to turn that into an accounts receivable. So the note ends on that maturity date no matter what. When they have a past due amount, we're going to turn it into accounts receivable, and we're going to continue to try to collect it. So they gave you an example of that one here. All right, so when we have a note, we're going to learn now how to record a note that is paid, which means that it's honored, or what does it look like when it's not paid or dishonored. So recording a note that's being paid, the principal and the interest are due on the maturity date. Here's the maturity date, so we're going to debit cash. We're going to credit notes receivable to remove the debt that they owe. We're going to recognize the interest we've earned by crediting interest revenue. The total of the amount that they owe from the note plus the interest equals the amount of cash they should be giving us. So that's what an honored note means, when they pay you when they're supposed to. But what if they don't? All right, well then we're going to be looking at what is a dishonored note. So a dishonored note means that they didn't pay you when they were supposed to. So instead of receiving cash, we're going to put it into an accounts receivable so we can continue to try to collect it. Again, that note is done. So we need to remove the note by crediting notes receivable for the face value and recognize the interest revenue. We still earn the interest whether they paid it or not. All right, so the other part we have to think about is sometimes we get to the end of the year, we have to do those interest accruals just like we've done before. So if we have an interest accrual, it's going to be a debiting interest receivable, crediting interest revenue, and it's based on the amount of interest that's accrued since the note was issued through the end of the year or through whenever you're doing your adjusting entry. Here they show you how to figure out how many days, and again, it's using the same concept as we did for maturity. So we're figuring out when it's going to be recorded and how many days have been processed from that date and how many days are left. So we knew that we had the accrual for December 16th to the 31st, so 15 days. So then we have to recognize that receivable that we set up for that adjustment in the previous slide. We have to recognize that receivable being paid and then accrue the additional interest revenue. All right. The other thing we're going to look at is, sometimes those receivables can be converted to cash before maturity. So we might be selling them to someone else, or we might be pledging them as a secure pledge against an asset. So if we're selling the receivables, we're receiving cash. There's some kind of a fee that we have to pay. Typically, it's an expense, and we're going to credit that accounts receivable. If we're pledging accounts receivable, we can raise cash by borrowing money and pledging those receivables as security for the loan. If the borrower defaults on the loan, then the lender has the right to be paid from those receipts of the receivable when it's being collected. So not something we see a whole lot, but something just to be aware of. All right, last thing for Chapter 9 is going to be our accounts receivable turnover ratio. It is calculated by taking net sales divided by the average accounts receivable. Remember, average means you have to add 2 years together and divide by 2. This is going to tell us how well management is doing in granting credit to customers when they're trying to increase those sales. So a high turnover means that management should consider using less strict credit terms to increase sales. A low turnover suggests that management needs to consider more strict terms and more aggressive collection efforts to avoid their resources being tied up in just accounts receivable. So they give you some examples here that you can kind of look at, but this closes out Chapter 9. If you have any questions, please let us know. Thank you.